I explained that sensitivity analysis measures the tolerable extent to which a project NPV can accommodate any change in variable. Okay? And then I listed the kind of variables that we are talking about, including the initial outlay, variable costs, incremental or specific fixed costs. I listed revenue, savings, scrap value, contribution, cost of capital, as well as the uh, project life. Okay, so I explained all the relevant concepts as far as sensitivity analysis is concerned. And I also provided you with the three different formulas that you can use to estimate sensitivity margin depending on the variable. Okay. Then lastly, we talk about uh, the interpretation of your results, because anytime you compute sensitivity margin, you are expected to interpret what you mean by the figures that you have achieved. All right. So that's basically what we did last time under sensitivity analysis. So today we are going to have illustration on that. We are going to have illustration to demonstrate all what we said under sensitivity analysis. Okay. So yes, this illustration number 4 relates to sensitivity analysis. So I will read for you. Okay. Mississippi PLC has sought your advice as a financial consultant on its investment proposal. It plans to diversify into the production of toilet soap. You are provided the following information relating to the proposal. The initial investment in plant and equipment will cost 4.8 million naira. The plant are expected to have a life of 10 years, okay, with negligible scrap value. The company plans to maintain a minimum of 80% of installed capacity each year. At this activity level, 240,000 units are expected to be produced. The annual production overhead, excluding depreciation, okay, is estimated at 360,000 naira, while variable cost is planned at 18 naira per unit. The market research carried out favors setting the selling price at 24 naira per unit. The cost of capital is 17%. You are required to A, advise whether the investment proposal is worthwhile. B, calculate the tolerable level at which the following can vary without any adverse effect on the investment proposal. 1. Initial investment cost. 2. Production cost. 3. Sales price. 4. Sales volume. 5. Variable cost. 6. Product life. And then 7. Cost of capital. All right. So that is the question. That is the question. Number A, you have to evaluate the project. You need to consider whether the project is financially viable by calculating NPV. Okay, so we are going to calculate the net present value in the A requirement. So in this number B requirement, examiner has told you to calculate the tolerable level at which the following can vary without any adverse effect on the investment proposal. Remember, we said that sensitivity analysis measures the tolerable extent to which a project NPV can accommodate any change in variable. You want to know the NPV you are going to calculate instead in the number A requirement. What is the percentage in any of these variables? How would any change in any of these variables affect the project's viability? Okay, what if your initial investments increase by a specific percentage? Can the project still be viable? If you increase your production costs Okay, can the project still be viable? What if your sales volume reduces? Okay, what if your sales volume reduces by 2%, 5%, 10%? Can the project still be viable? That is what sensitivity analysis measure. So the first thing we are going to do, whether examiner asks you or not, anytime you want to compute sensitivity margin, you need to first of all compute the NPV, because it is the NPV you are going to benchmark with the PV of the variables. Okay, so without wasting more time, I will stop sharing this and move to the working notes. So we want to determine, okay, uh, let me see. I am paying. So the name of the company is Mississippi. This is solution to illustration. What illustration is that? Let me check. That's illustration 4, page 71. Solution to illustration 4, page 71. So the name of the company is Mississippi Limited. All right. Number A requirements, you have to calculate NPV, because in that number A requirement, examiner is asking you to advise whether the investment proposal is worthwhile, meaning that you need to calculate NPV. So I would then say calculating net present value. Okay. To do this, I will then go to the question, what are the variables given to me to calculate my NPV? In the question, we are given selling price. You are also given variable costs. Selling price is 18 naira. Then is 24 naira. Then variable cost is 18 naira. That means I need to calculate contribution. Okay. Once I get my contribution per unit, I will then multiply with the number of units sold to get the total contribution. All right. Without moving to, let me see. This page will be for the NPV, sensitivity margin, the third one, the third page. Okay, without going too far so that we don't have so much gap. Let's do it this way. My NPV and decision will be on this page. Then let me do the working here so that I don't move too far away from the NPV. All right. So working number 1, I want to calculate, because in the question you have been given selling price and variable cost. That means you need to calculate contribution. All right. So contribution denoted as C. Contribution is equal to selling price minus variable cost per unit. So selling price is 24 naira per unit. Variable cost is 18 naira. Therefore, contribution per unit is 6 naira. Now that you have the contribution per unit, we need to calculate total contribution. Okay? Total contribution. So according to the question, the number of units given to you are told that we are given activity level of 240,000 naira, sorry, 240,000 units. So the company will produce and sell 240,000 units. So to now get the total contribution, so this will be equal to the units sold, which is 240,000, multiplied by the contribution per unit of 6 naira. So what do you have here?
1440.
1,440,000. So that's the contribution, that's the total contribution. That's on one side. Then the production cost. The production cost, according to the question, we are told that you are given annual production overhead, excluding depreciation, to be 360,000. You know, I told you that whenever you are given a fixed cost, excluding depreciation, that fixed cost is relevant. So you need to consider it. Therefore, I will then go back here. I want to calculate NPV. So you create a column for year, description of items, then we have cash flow, discount factor at 17%. The cost of capital given is 17%, then present value. Our figures will be restricted to thousands. Let's restrict our numbers to thousands. So year 0, we have the initial outlay. According to the question, initial outlay is 4,800,000. Our figures are in thousands, okay? Then discount factor at year 0 is 1. 1 multiplied by 4,800 will give us 4,800. Then annual cash flows. We have contribution. We have calculated contribution to be 1,440,000. The useful life of this project is 10 years. Our contribution is constant. 1,440,000 for year 1 up to year 10 is the same amount. Therefore, I need to calculate annuity factor of year 1 to 10 for my contribution. Contribution is 1,440,000. So let's calculate annuity factor. Let's use here. Annuity factor AF. AF is computed as 1 minus 1 plus R raised to power minus N. Everything divided by R equal. So here will be 1 minus 1. Cost of capital is 17%. So 1 plus 17% will give us 1.17 raised to power minus 10. Useful life is 10 years. Then divided by 0.17. What do you have here? So this will give you, okay, let me use my calculator. 1.17 raised to power 10 minus equal minus 1 equal divided by 0.17 equal, that's 4.659. So here is 4.659. That's the annuity factor of year 1 to 10 at 17%, 4.659. Okay. Again, the production cost, 360,000 is from year 1 to 10, is annual production cost. Okay, 360,000. It's a cash outflow, so it must be in brackets. Then 4.659. There is no scrap value. Examiner told you that the scrap value is negligible. All right, my NPV. Therefore, I need to multiply 1440. 1440 multiplied by 4.659 equal
I have
6709. 6709. Then
Approximate.
360 multiplied
let me see,
by
37.
4.659.
1677.
1677 in bracket. It's a cash outflow. Therefore, to now get my NPV, I will then say 6709 minus 1677 minus 4800. That's
Okay.
232 positive. 232 positive. So which shows that the investment proposal is financially viable. So examiner is asking you to advise whether the investment proposal is worthwhile. So since our NPV is positive, I would then say the investment proposal is worthwhile considering the
NPV.
positive NPV of 232,000 naira. That's it. Okay, that's that. So number B part of the question, examiner is asking you to calculate the tolerable extent, the tolerable level at which the following variables, okay, can vary without any adverse effect on the investment proposal. Our advice is that the investment proposal is worthwhile, that the company should undertake the investment. Your examiner is now asking you, what if the production costs changes? Can the project still be viable? What is the level of change in the initial outlay that will make the project to still remain viable? Okay, so that is what you want to calculate. Your sensitivity margin is more like break-even points, all right? Because once you calculate your break-even point, whatever the percentage you have attained, that percentage is what will make the project to be to remain viable. That is for your NPV to be zero. So that's any point above what you have calculated, then we make the project to become unviable. So number B, Roman figure 1. The first variable that we have here is initial investment cost. I would then say sensitivity margin of initial investments. Okay. Now, like I told you, I gave you 3 formulas last time. I said for all the variables, excluding cost of capital and the project costs, sensitivity margin is calculated as the ratio of NPV to the present value of the variable. Okay, so like in this case, initial investments, our sensitivity margin of initial investment will then be equal to NPV divided by present value of initial investment, or multiplied by 100%. Whatever you have calculated as your sensitivity margin must be expressed in percentage. Therefore, our NPV is 232,000. Figures are in thousands, divided by the present value of initial investment. Initial investments, we calculated 4,800,000. That's your initial investments. Okay, let me check this one to I. Initial investments. Okay, 4,800. Therefore, here will be 48 multiplied by 100 over 1. So what do you have here? 232 divided by 48 equal, then multiply by 100%, equal to 4.8%. Here is 4.8%. Let me explain. The interpretation of this is that, we have calculated our NPV to be 232, and we said the project is financially viable. And therefore, the project investment should be undertaken. We now want to measure the percentage change in initial investment that will make the project still be viable. Now, what is the change? This 4.8 is the maximum level to which the initial investment can increase. We can still increase this initial investment of 4,800 by 4.8%. So any point above this 4.8%, the NPV will be negative. That's the interpretation. That is the interpretation. If you increase it by 4.9%, you are going to have a negative NPV. You can try it on your own. So that's the implication. Therefore, I can then interpret to say that the initial investments should not increase beyond 4.8%. If not, the investment proposal will not be viable. So that's the interpretation of our calculation. You can see in this question, the examiner did not ask you to interpret. It is implied. There is no way you compute sensitivity margin without interpreting your results. Okay, so that's that. Then number 2, the second variable we are given in the question is production cost. So sensitivity margin of production cost. It's still the same formula, NPV divided by the present value of production cost. So NPV is 232, production cost, present value of production cost, based on our initial calculation, is 1677 divided by 1677 multiplied by 100 over 1. What do we have here? 232 divided by 1677 multiplied by 100. That's 13.8%. Here is 13.8%. So this is the tolerable level to which production costs can increase. This is the maximum increase in production costs. At any point above this 13.8, the project will become unviable. Again, you need to interpret your results. The production cost should not increase beyond 13.8%. Otherwise, the investments proposal will not be viable. All right, then number 3. Again, we can still increase our production cost to by 13.8. If we increase this production cost, the production cost is 360,000 naira. So we can increase it by additionally by 13.8%. If you increase it by 13.9, the project NPV of that 232 will change to negative. We change to negative because the maximum increment in production cost is 13.8%. The next variable is sales price. It's still the same formula. Sensitivity margin of sales price equal to NPV of 232 divided by the present value of sales price. I don't know the present value of sales price, so I need to go and do working for that. All right. Let's push our workings. This will be for number 3, number 4, number 5. Okay, let me just go here and do the working. Continue the working number 3 here. So I want to calculate PV of sales price. So to get the PV of sales price, first thing first, I need to calculate my sales. To get sales equal to selling price multiplied by the unit sold. Therefore, selling price is 24 naira. Unit is 240,000. So 24 multiplied by 240.
5,760,000.
This gives us 5,760,000. So now that we have the total sales, we can then calculate the PV. PV of sales will then be calculated as PV of sales value or sales price will be calculated as the total sales of 5,760,000 multiplied by annuity factor of 4659. So it will give you the present value of sales price. Okay, so multiply by 4.659 equal 26,835, 26,835,840. All right, so that's the total sales. Remember, our figures are in thousands. So we are going to restrict this one to 26,836. Figures are in thousands, so that you don't make a mistake. So 26,836. So divided by 26,836 multiplied by 100/1. So 232 divided by 26,836 equal, then multiply by 100 equal 0.8. That's 0.9%. Here is 0.9%. So this variable is cash inflow. Therefore, our interpretation will be different from what we have done so far. I will then say the sales price should not fall. The sales price should not fall below 0.9%. If not, the investment proposal will not be viable, will become unviable. So what we are saying is that, the sales price, we can, of course, we can reduce. The selling price, according to the question, is 24 naira. We can still reduce that selling price. We can reduce it by 0.9%. Okay, we can reduce it by 0.9%, and the project will give us 0 NPV. So at any point below this 4.9%, the project will not be, if you reduce it by 10%, for example, if you reduce it by 0.8%, for example, it will not be, the project will become unviable. Okay, so that's what we are saying here. The project, the selling price should not reduce below 0.9%. Otherwise, the project will not be viable. Okay. Number 4. According to the question, the next one is sales volume. Sensitivity margin of sales volume. And we said that whenever you are calculating sensitivity margin of sales volume, you should use the present value of contribution as your denominator. Therefore, this will be the NPV of 232 divided by PV of contribution 6709 multiplied by 100 over 1. So what do we have here? 232 divided by 6709 multiplied by 100. That's 3.5%. Here is 3.5%. So this one we have the same interpretation as the sales price. All right. So the sales volume should not fall below 3.5%. If not, the investment proposal will not be viable. Okay, so that's our interpretation. The next one, number 5, variable costs. Number 5, sensitivity margin of variable costs, which is calculated as NPV of 232 divided by the present value of variable costs. We don't know the present value of variable costs. We need to go and calculate it. So working number 4, PV of variable costs. Okay. So to get the PV of variable costs, you need to first of all calculate variable costs. So total variable costs will be calculated as variable cost of 18 naira multiplied by the unit produced. Okay, multiplied by the unit produced. Let me put it out first. This is variable cost per unit multiplied by unit produced. So here is 18 naira multiplied by 240,000 units. So this will give us 4,780,320, right? So let me see. 18 multiplied by 240,000.
4,320,000.
So here is 4,320,000 naira. That's the total variable cost. So to now get the present value of variable costs, this will then be equal to the total variable cost of 4,320,000 multiplied by annuity factor. Annuity factor is 4.659. This will give us 20 million what? Multiplied by 4.659. 20,126,880. So remember, our figures are in thousands. So this will be 20,127. Okay. So that's that. I will then come here, 20,127. 232 divided by 20,127 multiplied by 100 over 1. What do we have here? Okay. 232 divided by 2127 equal, then multiply by 100% equal 1.2%. Here is 1.2%. Okay, this means that the variable cost can increase by 1.2%. At any point above this 1.2, the project will become unviable. So the variable cost should not increase,
More than
beyond
1.2%.
1.2%. Otherwise, the decision to accept the project will change. Otherwise, the initial investment or the investment proposal, will not be viable. That's that. Then number 6. The 6th variable, according to the question, is product life. Okay? Product life. Sensitivity margin of product life. And we said that to calculate sensitivity margin of project life, it is calculated as project life minus break-even point of project life, all divided by project life, then multiply by 100 over 1. So which means that we need to first of all go and calculate break-even points of project life. Therefore, I will then come here, working number 5. I want to calculate break-even points of project life. Okay, to calculate break-even point of project life, I gave you 3 procedures. The first step, reduce the life of the project by 1. Step 2, calculate NPV of the reduced life. Step 3, then calculate the break-even point of project life. So in this case, the life of this project is 10 years. So when you reduce 10 years by 1, it will remain 9 years. Therefore, you are going to calculate NPV for 9 years. All right? So I would then say, normal way you calculate your NPV. All right? So item, cash flow, discount factor at 17%. Then present value. Okay? So year 0, year 1 to 9, year 1 to 9. It's no more year 1 to 10 because we have reduced the life of the project by 1. A wise student would have gone ahead and give me an annuity factor of year 1 to 9 before I ask you. NPV.
1 minus bracket 1 plus R over
So
bracket
here
close.
We have second lecturer in the class. I think that's Priska. You are talking to yourself. Then this one is contribution Then production cost. Here is 4,800. Contribution is 1,440,000. Production cost is 360. So somebody should give me annuity factor of year 1 to 9. What do you have there? Okay.
4.451.
4.451, right? Is that what you just said?
Yes, sir.
Hello?
Yes, sir. Yes, sir.
4.451. Okay.
Yes, sir.
So here is 4.451. So let's multiply. Okay. What's the present value? This one is 1602. 1602. Then this one is 1440.
409.
6409. So 6409, 6409 minus 1602 minus 48. Error. 6409 minus 1602
7.
minus,
7.
you said 7, right? Okay,
Yes.
that's positive 7. All right. Therefore, I will then calculate break-even points of project life, which is computed as internal rate of return. So here will be reduced life plus the net present value of the reduced life divided by net present value of reduced life plus net present value of the normal life. All of this multiplied by normal life minus reduced life.
5.
All right. So the reduced life is 9 years. NPV of the 9 years is 7 divided by 7 plus NPV of normal life is 232. Normal life is 10 years. Reduced life is 9 years. Therefore, 7 divided by 239 divided by 232 equal. Then multiply by difference between 10 and 9. That's 1 equal. Then plus 9 equal 9.03 years. Break-even point of project life is 9.03 years. Your answer must be expressed in years because we are calculating break-even point of project life. So in this case, I would then go back here to say, project life is 10 years minus break-even point of project life, which is 9.03. divided by project life of 10 years, all multiplied by 100 over 1. Final answer will then be equal to 10 minus 9.03 equal, then divided by 10 equal, multiplied by 100%. That's 9.7%. 9.7%. This means that the product life should not fall, should not fall below 9.7%. Otherwise, the investment proposal will not be viable. So we have reduced the life of the project by 9 years to get our break-even point. So if you reduce the life of this project by 9.7%, the project will become unviable. The project will become unviable. The tolerable level that you can reduce the project's life is 9.7. Anything below this 9.7, the project will not be viable. All right. Okay. The last one, cost of capital. Number 7, sensitivity margin of cost of capital. So this is computed as internal rate of return minus cost of capital divided by cost of capital multiplied by 100/1. So with this, based on this formula, it means that we need to go and calculate internal rate of return. All right. So after that, then we can complete our calculation. So working number 6, I want to calculate internal rate of return. Rate of return, IRR. We said that to calculate IRR, you are supposed to assume two discount rates that will produce two opposing NPV. One discount rate will give you a positive NPV, another discount rate will give you a negative NPV, then you interpolate. So without wasting more time, let's assume 20%. Assume 20%. Let's use that 20% to compute our NPV. Hopefully, we are going to get a negative NPV. Ahmed, mute yourself. Falashade, Ruth, mute yourself. Priska, you too, mute yourself, please. So, I want to calculate NPV. Create a column for year. Description of items. All right, then cash flow. Again, before I ask you, I will expect that you would have gone ahead to calculate annuity factor of year 1 to 10 at 20%. Okay? Don't wait for me to ask you. That will make our job faster. So year 0, year 1 to 10, year 1 to 10. Here is initial investments, annual contribution, production cost. Here is 4,800, 1,440, then 360. Annuity factor of year 1 to 10 at 20%. What you get? Yes. Okay. 1.2 raised to power 10 minus equal minus 1 equal divided by 0.2 equal. I got 4.192. 4.192. 4.192. Then I will multiply to get the present value. Okay, so 1,440 multiplied by 4.192 equal 6036. 6036. Then 360 multiplied by 4.192 equal 1509. 1509 negative. Therefore, 6036 minus 1509 minus 4,800. We've got a negative NPV of 273. So we have calculated one NPV before, and we used 17% in that one, and we got negative NPV of 232. Therefore, my internal rate of return will be calculated as lower discount rate plus the net present value of the lower discount rate over net present value of the lower plus net present value of the higher discount rate. Higher discount rates minus lower discount rates. So IRR, we assume 17% and then 20% for our IRR. Therefore, 17% is lower. 17% plus NPV. NPV of the 17% is 232 over 232 plus NPV of higher discount rate, 273. So higher discount rate of 20 minus lower discount rate of 17. So 232 divided by, that should be, is it 505? I think so. Divided by 505. Okay, equal. Then multiply by difference between 20 and 17, that's 3. Then plus 17, 18.34. Our internal rate of return is 18.34%. So now that we have computed, so 18.38, error. This is 18.38%. Now that we have computed the internal rate of return, we can proceed to calculate the sensitivity margin of cost of capital. So IRR is 18.38 minus cost of capital according to the question is 17% divided by 17%, or multiplied by 100 over 1. So this will give us 1.38 or 18.38 minus 17. That's 1.38 divided by 17. Then multiply by 100%. 8.1%. 8.1% is our sensitivity margin of cost of capital. Again, you then say the cost of capital, should not increase above 8.1%. Otherwise, the investment proposal will become unviable. Okay. Investment proposal will not be viable. So that's that. I think that's end of the question. That's end of the question. This is how to calculate sensitivity margin. This is how to calculate sensitivity margin. Let me know if you have any question for me before I switch so that we can move to simulation. All right. All right. So let's talk about, yes. What's your question, Kevin?
Well done, sir. Sir,
You're
when
welcome.
we now first calculation, we have variable costs and we have a production cost.
Yes.
In my own listing, I thought in our production cost, we all already have variable cost in the components of our production cost. Why are we still
Yeah.
finding present value of a variable cost and production cost? That's my first question, sir.
See, that is implied in the question. Now, if you are told in the question that annual production overhead, this is production overhead, is different from variable. Of course, you are right. Variable cost is part of production cost. But here, the production cost examiner is referring to is your production overhead. That's your
Okay, sir.
production overhead that exclude depreciation. All right. So it's different from the variable cost. All right, Kevin.
Yes, sir. Thank you. My second question. When we were calculating the one with 9.7%, please just let me scroll down a bit. The project life, we reduce where we remove 1 year from the lifespan of the.
Yes. What about it?
Sir, what if we use IRR instead of that? Because I heard you mentioned IRR.
It's the formula that, the formula looks like IRR. This is it now. So you can't just go ahead like that and say use IRR. So you need to first of all reduce the life of the project by 1. All right, to get your NPV before you now apply the IRR formula. It's not the same. So you can see if you use, you may misinterpret it. If you use the normal formula for IRR, you may misinterpret. But when you say you reduce life, so your mind will pick it up that okay, I've reduced the life of the project by 1 to 9 years. So instead of just using A plus NPV of A over that. So yeah.
Thank you, sir.
You are welcome. So let me stop sharing this and move to the study material. Let's talk about simulation. Okay. What's that? To do what? Come on, pick it under the drawer. The second to the last. Pick it, that's nylon there. Okay. Sorry about that. Somebody was here distracting me. Okay, let's move on. All right. Let me see. Resume. Now let's go to simulation. Let me see. So quickly, let's talk about simulation. Let me check. Just to be sure that the recording was done with you. Okay. So let's talk about simulation. You know, the last time we simulated that I experienced simulation in real life was the last time was in 2019. When I was working under employment during that time. Usually every year for the company, what we do is that, all right, so we operate in a building that accommodates almost 1,000 people, 1,000 workers, right? So we want to simulate in the event of fire incidents in the building, how long will it take the last person to evacuate or to move out of the building? All right, from the last floor, from the 10th floor to the ground floor, how long will it take the last person to go out of the building in the event of a fire outbreak? All right, so that's what we do on a yearly basis, and then each year we tend to improve. All right, you know, when there are incidents in a building, it's not as funny as, you know, when you are doing that kind of a simulation. There could be stampede, especially when you have so many people. Everybody is rushing to save his or her own heads. Nobody will have time. Whether we are matching somebody, you won't know. All right. So we are simulating to know how long will take the last person to get out of the building. That is simulation. That means it is not the actual thing. We have not experienced the fire outbreak. However, we are just simulating. What if, okay, if there are incidents in the building, how long will it take us to get out? So we are mimicking a model. We have designed a model that we want to mimic. We want to copy that model in form of a real life situation. So when you do that, what you are simply doing is simulation. Okay, what you are doing is simulation. So simulation represents the process of mimicking a real life situation. The process of mimicking a model in form of a real life situation. Okay, that is what simulation is all about. Now, how do you then calculate expected value using simulation? Very simple. To calculate expected value using simulation method, the most important thing to do is to simulate for each variable, okay? You need to simulate for each variable. You then use your simulated results to compute the NPV. What you are going to get thereafter is called simulation, expected value using simulation method. I repeat, to calculate expected value using simulation method, the most important thing you need to do is to simulate for each variable of cash inflow and cash outflow. Say, for example, you may be given variable cost, that's your cash outflow. You may be given revenue, that is cash inflow. Therefore, you are going to simulate for variable cost separate. You simulate for revenue separate. You then use your simulated result to go and compute NPV. The result is called expected net present value. However, when you are simulating, you are supposed to use random variables. Okay, you are supposed to use random variable for your simulation. So let me quickly show you. Let me see if I can get a space. No, let me go to the working notes. So I'll just give you the format for your simulation. Okay. For example, if you want to simulate for a variable, this is simulation. To simulate for any variable, you create a column for year. Then you create a column for first thing first. You create a column for this, let's say, for example, you want to simulate for cash inflow or for any variable. So you have the variable here, whether it is revenue or variable cost or whatever. Then you create another column for probability. Okay? You create a column for cumulative of the probability in percentage. Then you create a column for random allocation. Then finally, the last column will then be for the random number. We create a column for random number. So, of course, Let's say the variable is revenue. Whatever that you have been given, put it here. The probability will surely be given to you. Then you find the cumulative of your probability. You are the one that will determine this. Random allocation, you are the one that will determine it. Then this random number will be given to you. All right, so this is the format to simulate for any variable. This is the format to simulate for any variable. Now, one thing you need to understand is that when you are calculating, when you are simulating, you are going to be given set number. Your set number will be in pairs. All right, examiner will give you for set 1, for example, you are going to be given random numbers for cash inflow as well as a cash outflow. So you are going to pair the two together when you are calculating your NPV. So meaning that if, for example, you are given 2 set numbers, it means that you are going to calculate 2 different NPVs. If you are given 10 different NPVs, so the set number given to you will determine the NPV, the number of NPVs that you are going to calculate. So this is pretty straightforward. There is nothing much to it's not difficult to understand. So like I said, anytime you want to evaluate a project using simulation, you want to calculate expected value, expected net present value using simulation method. The first thing first that you need to do is to simulate for each variable. How do you simulate for each variable? You are going to use the random number given to you for the simulation, all right? Because it is only under simulation that you use random numbers. You can see that when we started, we talk about expected value method, we talk about standard deviation, we talk about coefficient of variation, then we just finish sensitivity margin. Each of them has a unique way of incorporating risk, okay, in the project. Okay, so for simulation also, once you can see random number, it means that you need to calculate, you need to evaluate using the simulation. Okay, once you can see random number, or at times examiner can call it tag number. Okay, examiner can also call it either tag number or random number. It's the same thing. Okay, so once you can see this random number in a question, that means you are supposed to simulate. Okay, you are supposed to simulate, and I've shown you how you are going to simulate. This is the format. So other than that, so it's as simple as straightforward as it is. Now, one thing you need to know is that whenever you are calculating expected NPV using the simulation method, you can never have optimal solution. You can never have optimal solution. Why? Because you are picking the number randomly. You are pairing cash inflow and cash outflow randomly. There will be a situation whereby you are going to ignore some cash flows. You are not selecting the entire cash flows. Therefore, you can never have optimal solution. The best you can have is good enough or near optimal solution. Okay, because not all cash flows are well represented. So that's what you need to know as far as simulation method is concerned. All right. So at this point, let's have illustration. Let's have illustration. Let me see. Which one am I sharing? Yeah. Okay. So you can read more. You can read more about the simulation in this material. Okay. You can read more about simulation in the material. On the high level, that's what I just explained to you. And these are the areas of application of simulation. Okay. So you can read it through to gain more insights. Okay. So let's have illustration on this. Okay. So let's have illustration number 2. Let's have this illustration number 2. It's on simulation. Okay. The following probability estimates, that's on page 70, illustration 2. The following probability estimates have been prepared for a proposed investment. Okay, we are given initial outlay, running cost, and then revenue. The company's cost of capital is 10%. You are required to A, calculate the expected net present value using the following tag numbers. Okay. Then B, explain any 4 merits of deterministic simulation model. All right, so that is the question. You want to calculate, examiner is asking you to calculate expected NPV, all right, using the following tag number. Once you can see tag number or random number, you can see examiner did not tell you to calculate simulation. So, but you can see tag numbers as given to you. That means we are supposed to simulate. You are going to calculate expected NPV using the simulation method. So to do this, let me stop sharing this and move to the working notes quickly. So solution to illustration 2, page 70. Number A, examiner is asking you to calculate expected NPV. I would then say calculating expected NPV. Now, before you calculate expected NPV, there are some procedures you are supposed to follow. You are supposed to carry out first. All right? The first procedure is to simulate for each variable using simulation method. Okay. So the first thing we are going to do is to simulate for each variable. Number 1, we have 2 different variables in the question. The first variable is running cost. The second one is revenue. Therefore, I would then say simulating for running costs. If you want to simulate for running costs, how do you do it? It's still the same format. The first item here will be the running costs. After running costs, we create a column for probability. Another column for the cumulative of probability in percentage. Then you create a column for random allocation. Another column for random number. So in this case, examiner called it tag number. All right. So according to the question, the running costs, we have 3 different running costs, 500, 600, 700,000. 500,000, 600,000, then 700,000. Then probability for running costs, according to the question, 0.4, 0.2, 0.4. 0.4, 0.2, then 0.4. Here will be 1. Next, to get the cumulative of the probability, in percentage. So the first probability is 40. 40 plus 20 will give us 60. 60 plus 40 will give us 100. Then random allocation, we are starting from 0, 0 to, from your cumulative of probability, the first one is 40. Therefore, 1 minus 40 will give us 39. After 39 is 40. 1 minus 60 will give us 59. After 59 is 60. Then 1 minus 100 will give us 99. Your random allocation is just like class interval. Therefore, I will then go back to the question. The tag number given to me for running costs. What are the tag numbers for running costs? Examiner told you that for running costs, set 1 is 70. So from my table, where can I find 70 from this random allocation? Where does 70 lies? 70 is in the third row. So here is 70 tag number. Next one, the next tag number is 52. Where does 52 lies? 52 is here. And the last one, the last tag number given to us is 90. 90 is in the last one, last row. So with this, I've simulated for running cost. If this one is still doing UYY, let's do another one for revenue. Number 2, simulating for revenue. Okay. It's the same procedure, the same thing, the same formats. Therefore, the revenue given to all for each year. Here I will indicate revenue, probability for revenue, cumulative of the probability in percentage. I will create a column for random allocation. Then tag number. Okay, so the revenue for the first year, according to the question, is 800,000. Here is 800,000, followed by 1 million, 1,100,000, and the final one is 1,200,000. All right. Probability for revenue. We have 0.15, 40, 25, 20. 0.15, 0.40, 0.25, 0.25, and then 0.20. Here is 1. All right. So to find the cumulative of the probability in percentage, the first one is 15. 15 plus 40, 55, plus 25, 80, plus 20, 100. So to get the random allocation, the first cumulative is 15. So 1 minus 15 is 14. After 14 is 15. 1 minus 55, 54. After 54 is 55. 1 minus 80 is 79. After 79 is 80. 1 minus 100 is 99. So give me the tag number for revenue as shown in the question. What's the first tag number?
35.
35. Look up and pay attention. Where does from our random allocation, where does 35 falls? 35 is in the second row. Here is
Yes.
35. Next one.
22.
22 will fall in the same row.
Yeah.
Next one.
68.
68 will fall in the third row. Here is 68. That's that. So those are the three. We are given three sets. So for revenue as well as a running cost. With this, we have simulated for revenue. So you are now going to use your simulated results to go and compute NPV. The NPV you are going to calculate will depend on the number of sets number given to you. In this question, you are given three different sets. So you are going to calculate NPV for each set, pairing revenue with the running cost. So I would then say set 1, calculating NPV. All right, calculating NPV. This is set 1. Create a column for year. Description of item. Cash flow. Discount factor. What's the cost of capital given in the question? 10%. Okay, you are given 10%. Then present value. So in this case, you are supposed to pair revenue with the running cost. So I will then go to the question for set 1. What is the tag number? What is the tag number for revenue? For set 1, what's the tag number for revenue?
35.
35. Tag number for running costs?
70.
70. So the useful life of the project is 5 years. All right, the useful life of the project is 5 years. Therefore, here will be the initial outlay. According to the question, initial outlay is 800,000 naira. So here is 800,000. 800,000. So for the revenue, tag number for revenue set 1 is 35. So 35 falls in the second row. Therefore, the revenue at that level is 1 million naira. 1 million naira. Year 1 to 5, running costs. The tag number for running costs for set 1 is 70. So 70 falls in the third row, which is 700,000 naira revenue. So annuity factor of year 1 to 5 at 10% will give us 3.170. Please confirm. 1.1 raised to power 5 minus equal minus 1 equal divided by 0.1 equal 3.791, rather 3.791. 791. Okay, here is also 3.791. So we need to multiply with the cash flow. Here will be 3,791,000. Then 700,000 multiplied by 3.791. 2653. 2653. 900 or 700. 700. negative. Then you get your NPV. In this case, NPV will be equal to plus 800 minus 3791,000. That's 337,300. 337,300 is the NPV. So I will do for set 2. If the first one we solve is doing YY, so in this second set, you can catch up. Cash flow. Discount factor remains 10%. PV, year 1 to 5, year 1 to 5. NPV. All right, initial outlay, 800,000. 800,000. So for the set 2, what's the tag number for revenue? Set 2.
22.
22 falls in the same place. So you trace it to the left. Revenue you have there is 1 million naira. Revenue, 1 million naira. Multiplied by 3.791. 3,791,000. Then set 2, tag number for running costs.
52.
52 falls in the second row. Trace it to the left. 600,000 is the running cost. Running costs, 600,000. Multiplied by 3.791. So 600,000 multiplied by 3.791 equal 2274. 2274
600.
600. Okay, then to get the NPV plus 800,000 equal, then minus 3791. 716,400. 716,400. So we are moving to set 3. Yes, Rose, what's your question?
Thank you, sir. Sir, sorry to take you back. I did not understand how you got that 3.791.
You calculate annuity factor. All right. Maybe you know the formula for annuity factor, Rose.
Yes.
So apply it in your formula. Apply the calculate annuity factor at 10%, year 1 to 5. All right, you should get the same answer.
Okay, thank you.
You are welcome. Present value. Year 0, year 1 to 5, year 1 to 5. Here is initial outlay. Here is revenue. Here is running cost. Okay. So initial outlay is 800,000. 800,000. Revenue, Set 3, what's the tag number for revenue? Set 3.
68.
68 is in the third row for revenue simulation. So when you trace it to the left, the revenue you have there is 1,100,000. Here is 1,100,000. Then what's the tag number for running costs?
90.
Set 3, 90. So 90 is in the last row, which is 700,000. 700,000. 3.791. 791. So we need to multiply to get the present value. I think we have done for, here is 2,653,700. This one is 2,653,700. Then 1,100,000 multiplied by 3.791 equal 4,170,100. 4,170,100. So, of course, this one is in brackets. Therefore, 4,170,100 minus 2,653,700 minus 800,000 equals 716,400. Okay, now we have computed NPV for each set. You are supposed to calculate only one NPV. Here you have calculated 3 different NPVs. Therefore, you need to find the average of your NPV. So I would then say expected net present value equal to, the first NPV we calculated was 337,300. 337,300 plus the second NPV 716,400 plus the third NPV 716,400. We added 3 variables together, so you divide it by 3 to get the average. All right, so expected NPV equal to 716 in my calculator multiplied by 2 equal, then plus 337,300 equal. So this will give me 17770. All right, 100 then divided by 3. Okay, divided by 3, that's 590,033. 590,033. Therefore, the expected NPV, examiner says you should calculate expected NPV. I would then say the expected NPV is 590,033 naira. Okay, that is the final answer. This is how to calculate simulation. This is how to calculate simulation. Let me see. Let me know if you have any question on this. And let me see if we can have one more illustration on this. Before we move to, we have decision tree outstanding. So let me see if you can have one more illustration. Before then, any question? If there's no question, I will switch. All right. Okay. Let me see. I'm not sure we have additional illustration on this in this material. But let me open to the golden book and see. Golden book. Okay. Let me share first. Move out. Okay, so let me see. Simulation. Where are you? Okay. Sorry, let me just search for the. Let me search if I can get one more illustration on this. Under simulation. So this thing will disappear again. Let me connect it. So that's uh where are you? Where are you? Okay. Yes. This is this is another question on simulation. This is another question on simulation. Let me see. Okay, this is the one we just solved. Okay. Okay. Let me just. Now, I need one of you to read this for us. I will share the question later on after the class. So somebody should read illustration number 8 for us.
All right, good evening, sir.
Moses, good evening.
All right. Adelaide Limited has prepared the following probability estimate for a proposed investment project. All figures in the table are assumed to be correct. Cost of capital is 12%. Required. Calculate net present value of the project. Analyze the risks inherent in this situation by simulating the NPV calculation. You should use the random number given at the end of the question to stimulate 3 sets of cash flows. Based on your stimulation results, what is the expected net present value? C. Explain briefly why EMPV calculated in A and the one calculated in B may not necessarily be the same. Then set 1, and that's the end of the question, sir.
All right. Thank you. So that is the question. What are you supposed to do? Examiner is asking you to calculate NPV. Let me see if I can quickly share with you so that we can be speaking on the same page. Let me see if that will be. Okay, let me reduce further so that I can share everything once and for all. Boost further. Okay. Let me remove this. So let me go to your WhatsApp and share with you. FM. Okay. Please, you can go to your WhatsApp and pick the question there in case. All right. So I'm going to latch this. All right. So let's solve now. You want to calculate NPV. So let me stop sharing this and move to the working notes. All right. The name of the company is Adelaide Limited. Number A requirements. Calculating NPV. What kind of NPV do you want to calculate? Pay attention, please. According to the question, we are to calculate NPV. You will notice that in this question, you are given probability, you are also given cash flow. It means that you need to calculate expected value. So you are going to calculate expected revenue. You also calculate expected running cost. You then use your expected value to go and calculate the NPV. So that will give us expected NPV. All right. So that's how we are going to answer the requirement number A. So in this case, I need to first of all calculate expected revenue. All right, I need to calculate expected revenue, then expected running costs. So I will say expected revenue. And you know that expected value is calculated by multiplying probability with the cash flow. All right, so what are the probability? Grace, you are writing on my screen. Now, for the revenue, probability is 0.15, 0.40, 0.30, and 0.15. So probability, which is P, is 0.15, 0.40, 0.3, 0.15. 0.3.15. Again, the probability must be equal to 1. Here is 1. Then, of course, after probability, we have cash flow, which is your revenue, denoted as X. Then you calculate expected value. So this will give it expected revenue, right? So revenue for the first one is 40,000, 40, 50, 55, 60. 40,000, 50,000, 55,000, then 60,000. Recall that expected value is calculated as summation of probability of X. That is, we are supposed to multiply probability with the cash flow to get your expected revenue. Therefore, 0.15 multiplied by 40,000 equal to 6,000. Then 0.40 multiplied by 50,000 naira, 20,000. 0.30 multiplied by 55,000, 16,500. Then 0.15 multiply by 60,000. That's 9,000. We add up everything together. That will give us expected revenue. So plus 16,500 plus 26,000. 51,500 is expected revenue. Again, we calculate expected running cost. Let me use here. So expected running cost. The same way we have calculated the expected revenue is the same we are going to calculate the running cost. So probability, cash flow, expected revenue, running cost. So what are the probability for running costs? 0.40, 0.25, 0.35, 0.4, 0.25, 0.35. Okay. This must be equal to 1. Expected running cost. So running cost for the first probability, 25, 35, 35, sorry, 25, 30, 35. 25,000, 30,000, 35,000. To now get the expected revenue, you multiply probability with the cash flow. So 0.4 multiplied by 25,000, 10,000. Then 0.25 multiplied by 30,000, 75. 0.35 multiplied by 35,000, 12,250. When you add everything together, that's 29,750. Now that we have computed expected revenue and then expected running costs, we can then proceed to calculate the expected net present value. So I would then say calculating expected net present value. To get the expected net present value, you are going to use your expected value you have computed, the expected revenue and the expected running cost to get your expected NPV. So create a column for year, description of items, cash flows, discount factor. According to the question, discount factor is 12%. Cost of capital is 12%. Then present value. Useful life is 5 years, so year 1 to 5. We have initial outlay. According to the question, initial outlay is 40,000 naira. ₦40,000. Then expected revenue. We have calculated expected revenue to be 51,500. Then expected running costs. We calculated 29,750. So we need to calculate annuity factor of year 1 to 5 at 12%. So this will be 1.12 raised to power 5 minus equal minus 1 equal divided by 0.12 equal, error. Okay, 1.12 raised to power 5 minus equal, okay, then minus 1 equal divided by 0.12 equal 3.605. Annuity factor is 3.605. Therefore, I then multiply 51,500 multiplied by 3.605 equal 185,658. 185,658. Then 29,750. 29,750. Is it 29,750? Yes, 29,750 multiplied by 3.605. That's 107,249. 107,249 minus. Then we find the difference. That will give us the expected NPV. Okay. Let me write this one to make it clearer. 49. All right. 185, 658, 185, 658. All right. Minus 40,000 minus 107,249. That's 38,409. 409. All right, that's the expected NPV. So examiner is asking you to calculate the net present value of the project. We have done that. Then number B, you are to analyze the risk inherent in this situation by simulating the NPV calculation. You should use the random number given at the end of the question to simulate the three sets of cash flows. Based on your simulation results, what's the expected NPV? So simply put, in this requirement number B, examiner is asking you to calculate expected NPV using the simulation method. You want to use simulation method to calculate expected NPV. Therefore, what are you supposed to do? Number B, calculating expected NPV using simulation method. So in this case, what are you supposed to do? Simple. First thing first, you need to simulate for each variable of cash inflow and cash outflow. You then use your simulation result to compute the NPV. The result is known as expected NPV using simulation method. Therefore, I need to simulate for revenue. I would then say simulating for revenue. Okay. Revenue. The same way we did in the first question. So I'll create a column for revenue. Probability. Then cumulative of probability in percentage. I will create a column for random allocation. Then finally, I will create a column for random number. We are given random number, not tag number in this case. So what are the revenues? According to the question, the revenue is 40,000, okay? 40,000, 50,000, 55, then 60. So 40,000, 50,000, 55, 60,000. Then what are the probabilities? All right, what are the probabilities? So we've calculated it before. Probability is for revenue is 0.15, 15, 40, 30, 15. 0.15, 0.40, 0.30, 0.35. Okay, next, I need to find the cumulative of the probability.
0.15, sir.
0.1, oh, okay, sorry. Error of mind. Thank you. 0.15. So I need to find the cumulative of the probability. The first one in percentage, here will be 15%. 15 plus 40 will give us 55. 55 plus 30 will give us 85. 85 plus 15 will give us 100. Then random allocation, we are starting from 0, 0. 1 minus 15, 14. After 14 is 15. 1 minus 55 is 54. After 54, 55. 1 minus 85, 84. After 84 is 85 to 99. I will then go to the question. The tag number given to me for revenue. All right. For revenue, 30, 20, 79. 30, 20, 79. So from my random allocation, where can I find the tag number 30, 20, 79. 30 will fall there. 30 is there in the second row. 20 is also in the same place. Then 79 will be in the third row. So with this, we have simulated for revenue. So we need to simulate for running costs. Simulating for running costs. Okay. The same thing. Here will be running costs, probability, cumulative of probability in percentage. Then we have random allocation, random number. Okay. Then the running cost as given to us is 25,000, 30,000, 35. 25,000, 30,000, 35,000. Probability of the running cost is 0.4, 0.25, 0.35. 0.4, 0.25. Let me write it. Then 0.35. So To now get the cumulative for probability, the first probability is 40%, followed by plus 25, that's 65, plus 35, 100. Okay. Then the random allocation, starting from 0, 0. 1 minus 40, 39. After 39 is 42, 64, then 65 to 99. The tag number for running costs, according to the question, 7100, then 94. So tag number 71, sorry, yes, 71 first. From our simulation for running costs, Priska, please mute. For our simulation for running costs, the first random number given to us is 71. Therefore, 71 will fall in the third row. Here is 71. 0, 0 will fall in the first row. 0, 0. Then the last one, which is 94. 94 will fall in the last row. 94. So with this, we have simulated for running costs. We have simulated for running costs. So you then use your simulated result to compute NPV. Now, in this question, we are given 3 different sets. That means we are going to calculate 3 different NPVs. So, calculating NPV. Set 1. We pair revenue with the running cost. Let me push this one. I've exhausted it. Okay. So for set 1, create a column for year, description of items, cash flows, discount factor at, I think 70%, 12% is the cost of capital. Then PV. Year 0, year 1 to 5, year 1 to 5. Initial outlay, revenue, running cost. For set 1, the random number for revenue in set 1 is 30. Therefore, from my simulation for revenue, 30 is in the second row. Here is 30. So trace it to the left. So the revenue is 50,000. So here will be 50,000. Here is 40,000 initial outlay. 40,000. Now, for set 1, running costs, tag a random number is 71. Based on our simulation, 71 is in the last row. So which is 35,000 naira. So here is 3.605. I think, let me confirm. We have solved it before. Annuity factor. Yes, 3.605. So we then multiply. Okay. 50,000 multiplied by 3.605. 182.50. Then 35,000 multiplied by 3.605. 126,175. Then we calculate NPV. Here will be 180,000. Okay, plus 40,000. Then minus 180,000. That's 13,825. Okay, so that's the NPV for set 1. I will do for set 2. So create a column for year. Description of item, cash flow, discount factor at 12%, then present value. Year 0, year 1 to 5, year 1 to 5. Okay, initial outlay, revenue, running cost. Now, for set 2, tag number for set 2, revenue is 20. So from our simulation for revenue, 20 random number 20 falls in second row, which is 50,000 naira revenue. So here will be 50,000. Then running cost, random number for running cost, set 2 is 00. 00 for our simulation. 00 is 25,000 naira. Okay, running cost for random number 00, that's 25,000 naira. Okay, multiply by 1, 3.605, 3.605. You multiply to get the present value. Here is 40,000, right? So, what do we have here? 50,000. Saida, I'm coming for you. 50,000.
250.
180,000.
250.
180, 250. Okay. Then 25,000 multiplied by 3.605.
9125.
9125.
Yes.
So the final answer,
50,125.
50,125 is the NPV for the first set. Saida, talk to me. What's your question? Saida?
Sir, the NPV for set 1 is
Yes.
14,075.
14,075. Okay. Let me see. Oh, is it 180 or 190, 250?
180.
180, 250.
180, 250 minus 40,000 minus 126,175.
14,075.
Oh,
Correct.
it's true. 14,075. You can see now, you know, in my mind, I believe the answer was correct, not knowing that I inputted wrong number in the calculator. You can see the same thing can apply on the day of exam. You won't know. You think you are doing the right thing. You are happy. The question is straightforward. Oh, I'm getting it. Meanwhile, you are putting the wrong number in your calculator. You won't know unintentionally. Okay, thank you for that observation. Now, next one, set 3, yes. So create a column for year. We're almost there. Description of item, cash flow, discount factor at 12%, then present value. Okay. So year 0, 1 to 5, 1 to 5. Initial outlay, revenue, then running cost. For set 3, the tag number for revenue is what?
79.
79. Revenue. Tag number is 79. So 79 is in the third row of your revenue. So which is 55,000 naira. Revenue is 55,000 naira. Then running cost. What's the tag number for set 3?
94.
94. So which should be, you trace it to the left. That's 35,000 naira running cost. 35,000 naira. So here is 3.605. 605. So then multiply. What do you have there? 126,175. Here is 126,175. So what do you have? 55,000 multiplied by 3.605. That's 198,275. 198,275 minus the rest. Minus 166,175. That's 32,100. 32,100 is the NPV. Okay. So now that we have computed NPV for each set, you need only one NPV, but we have calculated 3 different NPVs. Therefore, you need to calculate average NPV, average net present value. So to do this, you are going to add up, okay, average expected net present value. So you add up. The first one is 14,075. The second NPV we calculated was 50,125. And the third one is 32,100. You add the 3 of them, you divide it by 3. So when you add up, you have 32,100 plus 50,125 plus 14,075 equal 96,300 divided by 3. So the average expected NPV is equal to 32,100. So you can say the expected NPV is approximately 32,100 naira. So that's that. That's not the end of the question. Examiner is now asking you to explain briefly why the expected NPV calculated in A and the one calculated in B may not necessarily be the same. We have calculated expected NPV in A, and we got 38,409 naira. The expected value we calculated in B, we got 32,100. Why are they not the same? Examiner is asking you to briefly explain why they are not the same. Of course, they are not the same because different methods are used. Let me put it down so that we can close the class. All right. The expected value, the expected NPV calculated in A above is 38,409. Why that of B or in A above is 38409 and then B is 32,100. Therefore, the expected values, the expected NPVs are not the same because two different methods are employed. Okay, that's why they are not the same. In the A above, expected value method is used. Why the simulation method is used in B. In the above, in A above. In A above, let me write this. In A above, the expected value method is used. Why simulation method is used in B. All right. That's why they are not the same. However, the simulation method will not produce the optimal solution. However, the simulation method will not produce optimal solution because not all cash flows are well represented. Not all cash flows are well represented. Okay, do not produce optimal solution, but only good enough or near optimal. You will notice that when we are calculating the NPVs, when we are calculating the expected NPV, we are selecting our cash flows on the basis of the set number given to you. So we are ignoring some cash flows because we don't have tag number for them. For example, in the running cost, for example, running costs in the second row is 30,000. Because we do not have tag number, we ignore that 30,000. Even in the revenue, the highest revenue is 60,000. Because we do not have tag number for it, we ignore it. So we are selecting our numbers on the basis of the random numbers given to us. So there's no way using that, there's no way you can have optimal solution. The best you can get is near optimal or good enough solution. All right. So that is the end of the question. That is the end of the question. Let me know if you have question for me so that we can close the class. Let me know if you have any question for me so that we can close the class quickly and then we'll push to the next class. So in our next class, we are going to be having decision tree. All right, we are going to have decision tree. Then after that, after the decision tree, that will be end of risk and uncertainty. Okay, then after risk and uncertainty, we are moving to a brand new topic. Okay, we are moving to a brand new topic. Let me know again if you have any question. If not, we'll move on to we end the class and we continue in our next class by the grace of God. Okay. All right. So I want to say, in the absence of no further question, I want to say thank you to every one of you for watching behind. Even though some of you have already disappeared, that's okay. All right. So I will see you next time by the grace of God. Good night, everyone.
Good night, Mr. Adejua. Thank you very much, sir.
Yeah, Mr. Victor, good night.
Good night, sir.
Good night,
Good
sir.
night. Good night, everyone. Okay.